savings last as long as you do. So what Kim is going to talk about today is you've got probably a series of accounts. Maybe it's a 401k, maybe it's an IRA or IRAs, or maybe if you're lucky, you have a pension. Not many people, but some people in our generation still do. So how do you best make use of your money and to see it stretch over the period of time that you have it for? So I'm going to turn this over to Kim, and I'm going to listen too. Welcome.
Well, thank you so much for having me. And it was just wonderful to work with Barbara through the years. So she knows so much about what I've written about over the years, and just really great to have an opportunity to talk with you all. Just wanted to let you know a little bit more about me. As she said, I wrote about all kinds of different things for Kiplingers, answered lots of questions from readers about all kinds of retirement-related issues, whether it was withdrawals, Medicare, Social Security, things like that. Now I've been doing a lot of freelance writing, and especially for AARP, doing a lot of things for their website, magazine, U.S. News, and Military Officer magazine too. I don't know if there's any retired military people here as well, but they have special personal finance issues that I know about firsthand from my family. My husband retired from the Army about 5 years ago, and that's when we moved from the DC area down to Lynchburg, Virginia. But anyway, just to let you know that this is a really good time to have this talk because so many things have changed in the last year. First of all, the Secure Act had passed at the end of December that had made a lot of changes to retirement withdrawals. And people were just starting to get used to some of those rules when the coronavirus hit, and the CARES Act, another big financial law that changed a lot of tax rules, at least temporarily, then made some additional changes to the retirement withdrawal rules. Meanwhile, if you are a retired federal worker or a military person, the Thrift Savings Plan withdrawal rules just changed significantly in September. So all those things together make it just a really good time to kind of step back, reassess what some of these changes are and how that affects some of the strategies that you might have for withdrawing money from your retirement accounts. Just going to start out with a little summary about some of the big changes. The Secure Act, which was passed at the end of last year, made several changes, but three of the big ones that affect a lot of people are: it increased the age for taking required minimum distributions from 70.5 to 72. It also eliminated the maximum age to make traditional IRA contributions. So if you're even just doing a little bit of work, after age 70.5, you can continue to contribute to a traditional or to a Roth IRA and continue to build up tax advantage savings, which a lot of people can do just even a little bit, even if they're just earning a few $1,000s a year. And then the other thing that changed, one of the things that was not as positive to a lot of people, was eliminated the stretch IRA, which was the ability in the past to be able to pass an IRA to your children or grandchildren, and then they would not have to take distributions except for throughout their lifetime. They could spread the distributions out through their entire lifetime. The rule changed, and so now they must take the distributions within 10 years. And so that's one reason why it's a good idea to reassess some of your beneficiary designations and things like that. So that was the Secure Act, and people were getting used to that at the beginning of the year. And then coronavirus came and the CARES Act was passed, which had a lot of special deals for special situations. First of all, at the beginning of the year and right around when all those changes took place, the stock market just went crazy. And I imagine that, many of you all, as well as, me and my family, are looking at our investments and all the volatility. I mean, we go way down, then go up, then way down and up, and just incredibly stressful situation. Because of that reason, and because a lot of people also lost their jobs in March and April, the IRS had changed the rules just for 2020, where you're not now required to take a required minimum distribution from your retirement savings this year. And that leads to a whole other set of special withdrawal strategies for this year. For some people, that that change came after they had taken their required withdrawal for the year. And they just, after a few kind of fits and starts, the IRS just really made a very clear clarification, and is allowing people who had taken out that money before the RMDs were suspended for the year. They have until August 31st to put that money back into their account without having to pay taxes on it. And so the key thing with that is, anytime you don't have to take a required minimum distribution, you get to keep the money growing, tax deferred in the account. You don't have to pay taxes on it then. And so anyone who's been able to take advantage of that, really, especially in a year of volatility where they may have had to sell some stocks for losses in order to take out that money, having that 1 year temporary reprieve is a really big deal this year. Also, for people who, so many people are needing money for emergency expenses now, and under the CARES Act, they made several changes, and one of the big things is you're able to access your retirement accounts penalty-free for emergency expenses up to $100,000 from your IRA or other retirement plans without an early withdrawal penalty. So that really applies for the people under age 59 and a half. But you can also have 3 years to put it back in without having to pay taxes on that withdrawal, and that's a big deal because it's great to be able to access that money in an emergency, without having to take high interest loans and things like that, but you really are jeopardizing your retirement savings for the future. So for any people who have had to take out that money, temporarily to get by, maybe had lost a job, but then maybe might do better financially later on, can put that money back into their account and then have it just continue growing for the future, which is, the best thing to do if you can possibly afford to do that. Another just small change that affected some, earlier tax law changes is for 2020, you're going to be able to give up to $300 to a charity and take that as a tax deduction, even if you don't itemize. And that's a big change because when the tax laws changed a few years ago, they made the standard deduction so much higher, and a lot of people don't itemize anymore. And especially people, people who may be retired and aren't paying, may have paid off their house and didn't have a mortgage interest deduction, may not have been itemizing anyway, and weren't able to get a tax break for charitable contributions, or had to make some, do some different strategies like bunching contributions, making a lot of contributions in 1 year, maybe not as much the next year, so they could qualify, so they could pass that threshold to make itemized deductions. Well, so this is, it's $300, that may be less than what some people are giving to charities, but at least it's something that they're able to get the tax deduction for a charitable gift this year. Also, another key thing that's coming up really soon is because of the coronavirus, the tax filing deadline was extended to July 15th for 2019 taxes. And that also means that the deadline for making IRA contributions, HSA, health savings account contributions, SEP account, which is simplified employee pension that you may have if you have any freelance income, that deadline has not happened yet for 2019. So you still have about a week to be able to make some of those contributions if you can afford to do so and want to continue to build up some of your tax-advantaged retirement savings. Some of the key strategies because of these changes. Because there's no required minimum distributions this year, it's a particularly good time for people to consider converting some money from a traditional IRA to a Roth. The traditional IRA, you either put in tax deductible money or after tax money, depending on what your income was when you made the contributions. It grows tax deferred, and then when you take withdrawals is when you finally have to pay taxes on it. Roth money, you don't get the current tax deduction, but you can withdraw the money tax-free in retirement, and you don't have requirement minimum distributions on that money. So converting money from a traditional IRA to a Roth, you'll have to pay taxes on the conversion, but then the money grows tax-free after that. And that can just be really valuable because especially if you have a taxable pension or if you have a lot of money in a 401k where you are going to have to pay taxes on the withdrawals in retirement, retirement. Having some money in a tax-free account like a Roth just gives you another pot of money to tap without increasing your taxable income. And so if you don't have to take an RMD this year, usually you might have had to take, several $1,000s from your retirement accounts and pay taxes on them. Instead, this year you may want to take some of that money, whether it's the same amount or even more, depending on what you can afford, and pay taxes on that and convert it to a Roth IRA so it can continue to grow tax-free for the future. This is good even for people who didn't have RMDs, even people who are younger than 70 and a half, because if your investments are still down and you get to make the conversion while the investments are down, the tax bill on that conversion is going to be smaller than it would be if the investments were worth more. Also, tax rates are at a low level right now. So for all those things together, it's just a really good time to consider converting some money from a traditional IRA to a Roth for the future. Also,
can I ask a question, Kim?
Sure,
This
yeah.
is Beverly. You talked about converting from a regular IRA to a Roth IRA. But if your IRA is part of, Fidelity Fund, a Morgan Stanley, all of that, can you convert to a Roth IRA and still be in those situations? Or does it have to be a separate IRA that you set up, say, through, your bank?
This is, an answer. I should know the logistics specifically. Talk to your IRA administrator, but I believe that when you do the conversion, you're actually just changing what the titling is of the IRA, and you're paying the taxes on it. But I believe you can keep the investments as it is, and you can definitely keep it with the same administrator. So if you had it with Fidelity, just talk to Fidelity. And in fact, if you go to Fidelity's website, because they have a lot of great things about IRA conversions right now, they're one of the best ones for education, and talk with them about making the conversion, and they'll tell you about all the steps. But I don't believe anything has to change with the investments, and you can definitely stay with the same administrator.
Thank you.
Sure. Another key thing, and this is also good timing to talk with your, if you have an IRA, talk with your administrator, is you do have until July 15th, 2020 to contribute to an IRA or a SEP account for freelance income for 2019 income. And, a lot of people already made, if they were going to make their contributions, already made those contributions. But some people may not have realized they're eligible to make certain contributions. For example, you generally need to have earned income from working in order to be able to contribute to an IRA. But if you're just doing some if you're primarily retired, but just doing some part-time work or some freelance work, that still can be enough to be able to contribute to an IRA. If you're 50 and over, you can contribute up to $7,000 for 2019, or the amount you earned from working during the year. So if that was less, you can only contribute up to that amount. Also, if one of you has some income from working, but the other spouse doesn't, the working spouse can make a spousal IRA contribution in the other spouse's name. And if the working spouse is only earning a certain amount of money for the year, it still can't be more than that amount. But if they're earning more than $7,000 a year, they can contribute the full amount to their IRA. If they're earning more than $14,000 a year, they can also contribute the full amount to their spouse's IRA. And if your adjusted gross income for 2019 was less than $203,000 if you married filing jointly, or $137,000 if single, then you can contribute that money to a Roth IRA. And like I said, the Roth is just great because even though you don't get the tax break now, that money grows tax-free for the future, and just gives you that extra pot of tax-free money to tap when you're figuring out which accounts to access as you need to get your retirement income. Another great thing that a lot of people, and I love talking about this, is you still have about a week to contribute to a Roth IRA for your grandkids, kids or grandkids. There's no minimum age limit to be able to contribute to a Roth IRA. You just have that same rule that you have to have earned some money from working. And so if your grandchild had a summer job last year, you still have up to July 15th to contribute up to $6,000. For people under 50, it's $6,000 per year to a Roth IRA for them. And once again, they can't contribute more than they earn from working for the year. So if they, earned $2,000 for the summer, they can't contribute more than that. But you can even give them the money to contribute. And it's just a wonderful way to be able to give kids a great head start on tax-free savings for the future. If the child is still a minor, you usually have to fill out some extra forms with your IRA administrator, to open a custodial IRA for them. But then it'll become, it's theirs with you as the custodian, and then becomes fully theirs when they reach the age of majority. And then I just wrote an article for US News that mentioned some of the statistics. I talked to the financial planner in Florida, one of my favorite planners, and she had said, I'm just looking at my notes, that she'd run the numbers that someone who's 18, if they started contributing $6,000 per year at 18, boosted their contributions to $7,000 a year at age 50, and earned 6% per year on their investments, they could have more than $1.6 million by age 65, tax-free. So, you're probably not going to be making those contributions for them all along, but you could get them started in the retirement savings habit. And if they continue on with that, it's going to just give them this tremendous tax-free source of money in the future. Another key thing this is for anybody, but especially if you're helping out young kids or grandkids getting started, they can also, they can't access the earnings tax-free until after age 59 and a half, but they can take the contributions without penalties or taxes at any time. And so if you and they have been contributing to this account for several years, and then they're maybe in their late 20s and want to put a down payment on a house, they can withdraw that money from the account without any taxes or penalties. And that just gives them just an extra source of money that they can access, when they need it, even before retirement. I had mentioned about the SEP account. If you had any freelance income or just did some consulting work on the side, you can contribute to a SEP account until July 15th for 2019 income. You can contribute up to 20% of your net income from self-employment. And usually if you have a choice, if you've done some freelance or consulting work, you have a choice between contributing to a SEP account or a solo 401k. And a solo 401k can actually be great because it's a lot more like a 401k. You can make larger contributions if you have lower income, but to do that for 2019, you had to have opened that account before December 31st. That rule is actually going to change starting this year. So for this year on, if you have self-employment income, that's just a great way to be able to, get a tax deduction and have that money grow tax deferred for the future. And finally, changes because of the recent rules. Also, it's a good time to review your beneficiary designations. Because of the Secure Act, now if you did have your children or grandchildren as your beneficiaries, just keep in mind that they'll no longer be able to spread those withdrawals out for their whole lifetime. They'll have to take them within 10 years. It's still a very good deal for somebody who's inheriting those accounts. But just, since those rules have changed, it's just a good idea to make sure that the people you had wanted to inherit the accounts still do. Also, a lot of people just don't realize that the beneficiary designations in their IRAs, 401ks, their retirement accounts, they supersede anything that's in your will. So a lot of people update their will when they get married, have children, things like that, and forget to update their beneficiary designations. And especially if people get divorced and remarried, that can just lead to not having the people who they thought were going to inherit the money inherit it. So it's just always a good idea to check all those beneficiary designations on your retirement accounts. One thing at the beginning I had mentioned, I know that Barbara is I imagine your family has a thrift savings plan money, and so many people, federal employees, we have thrift savings plan money because my husband was in the Army, and they just changed their withdrawal rules in September, effective for September. The law passed a while back, but it took a while for it to become effective. And in the past, a lot of people didn't realize that in the past, you really had limited limited options for taking the money from the thrift savings plan to retirement. You could either take one partial withdrawal, then after that would have to take out the whole lump sum, or you had to convert it to a life annuity or sign up for monthly payouts that could only change once a year. Well, finally, they changed the laws to make them kind of more in line with 401k and what everyone else had been used to, and give you just much more flexibility. You really have, can take the withdrawals whenever you'd like. You can set up installments so it's paid out automatically, but you can change those installments whenever you like. And so if you have a thrift savings plan and you hadn't accessed it yet, and we're thinking about, whether or not you wanted to roll it over to an IRA so you'd have more flexibility, you may want to consider keeping it in the TSP, because you have pretty much the same flexibility as you have in your other retirement savings plans. One thing, I do some articles for Military Officer magazine, and this applies both to military and federal retirees, but one thing that they'd let me know that I hadn't thought about is when you do withdraw the money from the TSP, you can't specify which account to tap. So if you have some money invested in the G fund, which is the kind of fixed income fund, the government fund, and then some money in the L fund, which is the life cycle fund, they take a portion of it pro rata from each of your investments. So you can't have it all come from the G fund. Whereas if you were in an IRA, you could generally specify which accounts to tap. So just keep those things in mind as you're starting to take out some of that money, because if you're at the beginning of retirement and you need to start taking some withdrawals, you'll want to keep enough money maybe for 2 or 3 years worth of withdrawals in a fixed and stable account like the G fund, so you don't have to worry about the market's ups and downs as we've seen for this year. But you do probably want to keep some of the money invested for the longer term, because you could be retired for 20, 30 years or more. So it really is just a balance, looking at what your portfolio is and matching that to your time frame. And when it does come time to take those required withdrawals or withdraw whatever money you need, just make sure that you have that money there ahead of time if you can, so you don't have to worry as much about the market volatility as we had over this last several months. Another few key things I just wanted to talk about, 3 timely personal finance strategies aren't necessarily because of these new laws, but just things that I think are really important for people to keep in mind when taking retirement withdrawals. One of them is to consider the potential cost of long-term care in your retirement plans. The average cost of care in a nursing home, Genworth, which is a long-term care insurance company, does a great study. It's at genworth.com/cost of care. And you can look at the average costs by state, by city, across the country. And across the country, on average, it's just slightly over $100,000 for a private room in a nursing home each year. And the cost of assisted living and the cost of having a home care worker come into your home about 44 hours a week. Both of those are about $50,000 per year. And so, the average time period that someone needs care is about 3 years, but some people need care for way shorter and may never need care. And some people, especially people who have a family history of Alzheimer's and dementia, may need care for much longer. So it's just really important as you're making your retirement plans to factor in those potential costs and think about where that money could come from. A lot of people assume that Medicare covers long-term care costs. It doesn't. It's very, very limited situations where it covers some of those expenses. Medicaid ends up paying a lot of long-term care costs, but it's because you've had to spend pretty much all of your assets and have very, very little assets or income. So it really is good to have some savings set aside. And so many people, my age and of all generations really are learning about these costs from helping their parents. I know my parents and my grandmother had my grandmother was 10 years in a nursing home, and we learned a lot about nursing home costs there. But one good thing is to just get an idea of what the costs are in the area where you plan to live, whether it's where you are now, whether you plan to live near children. Sometimes it can also help make your decision because some places are a lot less expensive than others. And then think about how much of those costs you might be able to pay from income coming in, either from a pension or Social Security, because you'd still have that money coming in, and how much you could afford to withdraw from your retirement savings for those costs. And then if there's a gap you'd like to fill in, then consider long-term care insurance or some other type of coverage. Long-term care insurance has gotten a lot more expensive over the last few years because so many people have been using it. So many people have been needing care and not dropping their policies before they need care. The cost of care has gone up a lot, and also with interest rates down, insurance companies' investments, it's been harder for them to earn money on their investments. So all those things together mean that if you're buying a long-term care policy now, it is quite a bit more expensive than it had been in the past. But I generally recommend kind of doing a balance between seeing how much you could afford to pay from your savings, and then maybe getting a long-term care policy to fill in some of those gaps. So you at least know you have a pool of maybe $200,000 or $300,000 that can cover some of those expenses. I generally recommend looking at like a 3-year policy. That's usually a good balance between cost and coverage, and can cover people for the average stay that they need care. And there's other ways to get coverage as well. You can get a separate standalone long-term care policy that pays out if you need care, but doesn't pay anything if you don't need care. More people are starting to get interested in these hybrid long-term care life insurance policies where you generally have to put a much larger lump sum of money in at first, but if you don't end up needing care, your heirs will get a life insurance benefit. And so, if you work with a financial planner, or you're thinking about some of these options, just look at all the options out there to consider how you might fill in that gap to help supplement your savings if you do end up having those expenses. One interesting thing, I did an article for US News a few months ago about how coronavirus has affected long-term care insurance. And some insurers I think they've been opening up a little bit since then, but this was in April and May, had temporarily stopped issuing policies to people over age 69 or 70. One company went as low as 65, and we're waiting until things were settling down a bit before issuing policies at those ages again. Also, they were not offering the best rates for people who have come in contact with the virus or in a high-risk group. And if someone had a positive test, they're generally wanting you to wait 3 to 6 months after receiving a negative test before applying for a policy. But I also discovered that these rules varied a lot by insurance company. And so, if you are looking for a policy these days, it's a good idea to look at several companies, compare what their rules are and what their costs are, because everyone, this is such an unprecedented situation these days, and every company was kind of looking at it from a different perspective and
Yep.
making some different changes.
Kimberly, a question.
Yeah.
One of the things to think about also with long-term care is if you've got disability insurance, there are some gaps between when disability kicks in and long-term care kicks in, and you sometimes have to wait a certain period of time to exercise one over the other. The other thing to think about is when you really are talking with a broker, make sure that your long-term care policy has an inflation factor to it, so that you're not paying money from 5 years ago and the costs keep going up. So yes, that's the other thing to consider in your budget, is that LTC is going to continue to go up, but the sooner you start, the better you are off. Yes, it's an increment, but better than starting from scratch.
And I totally forgot to mention that, and that is such a great point. It's usually in the back several years ago, it was really important for people to get a 5% annual inflation adjustment with their long-term care policies, and that was pretty standard. And for people, if y'all already have a policy and have that, that's incredibly valuable, because now most of the policies have just a 3% inflation adjustment, and that's still good, and that helps since the prices are higher now for people who are buying policies at this, from this point on, that helps the policy stay a bit more affordable. But if you've got that 5%, oh my gosh, that's incredibly valuable. And it's actually really interesting too, because several companies have raised their rates for people who bought policies a few years ago. And they give people several options. Either you can increase your premiums, pay the extra premiums that they want you to pay, or you can cut back some of your coverage to keep the premiums the same. And one of the options sometimes is to cut back your inflation adjustment. So before you make any changes like that, it's really a good idea to do that calculation and see how big your daily benefit has grown, because it's really neat to see, if you've had a policy for 10 years or even more, the daily benefit at that 5% compounding really has grown a lot. And then to do your calculations and see, oh, do I want to change that, cut that down to 3%, or do I want to maybe not have like lifetime benefits? People used to buy those, are incredibly valuable, but are very expensive to buy now. So some people cut back their benefits. Another thing is, if you're buying a new policy with a spouse, you usually get a really significant spousal discount. I think because they figure that the spouses might take care of each other for a while and delay someone needing extra care. There's also another strategy is shared benefit policy. And sometimes if two spouses are getting coverage at the same time, they can, instead of each getting like a 3-year benefit period, they can get a combined benefit period of maybe 5 or 6 years. And that way, you don't know who's going to need care for how long or who is even going to need care, but it kind of helps you with play the odds. And that way, if one spouse needs care for, 5 years, the other spouse could still have 1 year of coverage. If one spouse doesn't need care at all, the other spouse gets, the whole 6 years. So just a lot of strategies. And that's just a great point about talking with your broker about some of those options.
Kim, may I interject something as a current user of long-term care insurance?
Yeah.
Another feature is to make sure that it will pay for home health aides. And that has been very important for us. Also, make sure that the policy has a waiver of premium, so that if you unfortunately, God forbid, have to use it, you stop paying premiums.
And the home health care and I'm so glad you brought that up, because there's all these things too. A lot of the older policies, some of them are only nursing home care and not home health care. And the newer policies generally have both, but they may have a different waiting period for home health care than nursing home care. And usually people need home health care first. And so some companies have a 0-day waiting period for home health care and a longer waiting period for nursing home care, which ends up working out for a lot of people. But the way they can calculate the waiting period can vary a lot from company too. There's all these like nuances. And like you said, when you start using it, that's when you realize all these things that, you don't realize that it can make, thousands of dollars of difference. There's some of the waiting periods are a calendar day waiting period, which counts the days that you've used care. So for home care, that's really helpful because you may not need care every day. You may need someone to come in a few days a week. Actually, not necessarily helpful in the calculation, because if you only need someone 3 days a week, it's only counting 3 days a week towards that, maybe 60-day or 90-day waiting period. Some of them are called, so there's calendar day, and there is the other kind of waiting period starts the clock ticking when you first need care. And whether you need care 2 days a week, 3 days a week, it counts the whole week. And so just take a look at how they're calculating that waiting period, especially if you're going to be using home care, because that can make thousands of dollars worth of difference in what you're going to have to pay yourself before the policy pays out. So I'm so glad you brought that up. There's all these nuances. Another thing for Another thing that, I mean, I don't know if anyone here has money in a health savings account. You know, you can't make new contributions to an HSA after you sign up for, after you start receiving Medicare benefits. But for people who aren't receiving Medicare yet, it's just a wonderful way to build up a source of tax-free money for retirement. People say for retirement health expenses, but I say for retirement expenses, period. A lot of people don't realize that, you know, not only can you use HSA money, you know, it's HSA contributions, it's a triple tax benefit. The contributions are tax deductible or pre-tax if through an employer. It grows tax deferred, and then you can use it tax-free for medical expenses in any year. So it's not like an FSA that, you know, people have had for years where it's use it or lose it. You can use it anytime in the future. And a key thing is, even though you can't make new contributions after you're on Medicare, once you're 65, if you already have money in that HSA account, you can use that money tax-free in addition for any out-of-pocket medical expenses. You can also use it for Medicare Part B premiums, Medicare Part D premiums, and Medicare Advantage premiums. You can't use it for Medigap, but you can use it for those other Medicare premiums. And so even if you have your Medicare premiums paid automatically from your Social Security benefits, you can take the money out of the account tax-free and reimburse yourself for those costs. So, you know, I don't know if any of you all, you know, still have the ability to do that, but it's just, you know, or have money in an account there, but it's just an incredibly valuable. And I think especially people who are coming through work now, you know, a lot more employers just in the last few years have started to offer HSAs. Some of them make contributions to the account. It's just, it's one of my favorite things for people to be able to really figure out how to maximize those benefits. There's like a weird quirk to the law, and I just wrote about this for AARP's website, was that if you keep your receipts from the medical expenses, and so say you know, had your deductibles that you paid, but instead of tapping the HSA, you paid with other money. If you paid for your prescription drugs with other money, but it was eligible HSA expenses, keep those receipts, because you can actually withdraw that money from the HSA anytime in the future. For any expenses that you incurred after you opened up that account, if you had eligible expenses you paid with other money, you hold on to those receipts, and even years later, you can withdraw that money tax-free from the HSA for those expenses. And so a lot of the HSA administrators, and Fidelity is one of my favorites with these, because they just make things really easy to use. They've got some tools that let people kind of keep track of their medical expenses and how they paid them, and whether they paid them yet with your HSA, and lets them just keep that money in the account longer. And then when you start to, you know, then when you finally do need the money, even if it's years later, you can take it out tax-free. Another thing is, if you have an HSA, you can use money tax-free from that to pay for a portion of long-term care insurance premiums. And it's based on your age. Let's see, it's $4,350 a year you can withdraw in 2020 if you're age 61 to 70 for long-term care insurance premiums, and that's per person. And if you're 71 or older, it's $5,430 a year. If you don't have an HSA, that's the amount of money that you can, if you deduct your medical expenses on your income taxes, you can take that money as a part of your medical expense deduction up to that same limit. You can't do both, but you can do one or the other. So there's just a lot of neat strategies that help you kind of stretch your money for paying, especially for paying long-term care premiums. And then two other things. One of the other things is contesting the Medicare high income surcharge. Most people pay $144.60 per month in 2020 for Medicare Part B, but some people pay a lot more. And if you're single, but your modified adjusted gross income is more than $87,000 in 2020, or more than, actually, if I'll talk about the year then, because it looks back 2 years. But if your bonafide adjusted gross income is more than $87,000 or more than $174,000 if married filing jointly, then you may have to pay a lot more for your Medicare premiums, at least for the year. And with the high income surcharge, the monthly premiums rise to $202.40, or at very high income levels, $491.60. each month. And the key thing is that the income that it looks at is your last income tax return on file. So for 2020, they're looking back generally at 2018 income. And so, you know, if you're retired now, your income may not be up there. Although if you have a taxable pension and are taking a lot of money from tax deferred accounts where you do have the tax bill, you may be coming up against that, you know, even after retirement. But for people who retired, say you retired in 2019 and your income is way less than it was in your tax return, last tax return on file, you can contact Social Security Administration and fill in a form. It's form SSA-44, and it's called the Medicare Income Related Monthly Adjustment Amount Life-Changing Event. And you can fill in that form and submit evidence to Social Security that your income has decreased since your last tax return on file for certain eligible life-changing events, which is things like marriage, divorce, death of a spouse, and job loss. And job loss includes retirement. So a lot of people don't realize, and just they get there, you know, right around the beginning of the year, right before that, they get what they call their IRA adjustment. And they get this, you know, they're going to have to pay all this extra money and don't realize that, you know, if they have had one of those eligible life-changing events, including retirement, or if their income has, you know, if they lost their job and their income has changed significantly, that they can contest that life-changing event and get their premiums decreased for the year.
Kimberly,
Yes.
it's based on the family income or on the individual who's under Medicare income?
It's based on the modified adjusted gross income. So that's and the other thing that's tricky is those, you know, those Medicare premiums are per person too. So if you get it reduced for the, you know, if you get it reduced for one of you, it could be reduced for both of you, and that's going to make a big difference. But the good thing is that, yeah, you that form says all the information that you need to provide. You generally need to provide like a letter from your employer saying that you retired. And then they kind of, you know, look at the end of the year after you finally do file your taxes to make sure that it, you know, kind of lines up with what you said was happening. But it's a huge difference. And another thing, you know, I talked about making Roth IRA conversions earlier. One thing to keep in mind, you need to be careful if you're making a Roth IRA conversion, is in a year you make a conversion, your income may be unusually high that year. And that alone is not going to make you eligible to contest that high income surcharge. You know, if you haven't had, you know, death, divorce, marriage, job loss, things like that, you're going to have to pay higher Medicare premiums, at least just for a year. And then if your income, you know, goes back down to normal the next year, then it'll be readjusted and you may not have that high income surcharge again. And that's where, you know, with not having to take RMDs this year, it's, you know, particularly good time to consider the Roth conversions if you are over, you know, 72, because you can make that conversion without really having to increase your income a lot more than what you would have had to do.
Just a couple of comments on what you're talking about with the IRMA and all that, because I've had this now for a couple of years. They do go back 2 years on what your adjusted income is on your tax return.
Yeah.
You have to pay the premium, the higher premium, until it is adjusted back. You will get a refund in your check, maybe months later, but it eventually will get there. And be prepared. If you retire this year, they're going to go back to 2018 and figure it out. In 2021, they might come back again and give you the adjusted one, because I had to do it for 2 years, and then they finally got their act together, and now it's not a problem. But be prepared to do it maybe twice. And the third thing I did is I went to the IRS office with my materials, because I tried to do it on the phone and forms and what have you. It was a nightmare. So going up to the IRS office, you know, up there, office 650, it was easy peasy in and out, and it worked like a charm both times. So just a little bit, little help that might make it easier for the next person.
It's because one of our editors, Barbara Kevin, had this exact same experience. He said that he filled in the forms and then the bills he kept having to pay the higher amount. And he, was just like, do I pay it? Do I not pay it? And someone who had gone through it before him had told him the same thing and said, just keep paying it. And then suddenly, like, all this money appeared in his account because he had direct deposit, and it was the reimbursement for the extra amount. So that is a great. And I just did an article, it hasn't been posted yet, for AARP about that strategy, and I may ask you about some more questions at some point, because that's one of those things that you can read all the forms about it, but until you've talked with somebody who's gone through it, you don't realize that, especially that you have to just keep paying that money, but they actually will pay you back. And right now, I know when I wrote that article, and that was a few weeks ago, the Social Security offices were closed. I think they're still closed, which makes it a little complicated right now. So people may want to wait a little while or just do what they can online. But when the office is open, that makes it just so much easier. And that's when they can tell you, this is, and they can give you the little, paperwork that shows you when you went there and all of that, so you have that, because I know that my editor had held on to that just in case he needed to provide that to someone if they didn't give his money back. So thank you that's a great.
This is Sylvia, is that the IRS office you went to, Beverly, or the Social Security office?
Oh, I went to the Social Security office. It's not the IRS office. It's a Social Security situation. So it's the one down there, just about at the Beltway and 650, down that end, and that's where I went.
I used to live in Tacoma Park, so I know exactly where that is. That was not far from me. Yeah, that's it. And, once you've had to deal with all of that, then you kind of know to keep that in mind for the future too, because that's where, making that Roth Ira conversion or having money in an HSA that you can tap tax-free, or any money that you can tap in a Roth tax-free in the future, if you are getting close to that income cutoff later on especially because of 401k withdrawals or a taxable pension, you can tap some of the money in those tax-free accounts and kind of keep yourself below that limit going forward, because like I said, the life-changing events, especially retirement, that's one of the reasons why you can get it reduced. But for some of those other things, if you've sold property and had a big taxable gain on that, or had stock options or something like that, you're not going to be able to get contested and get it reduced, but it will eventually be readjusted the following year if your income's back down. So that's that affects so many people. And then finally, one thing that not as much a deal this year because you don't have RMDs, but another one of my favorite strategies for people who do have RMDs, so consider this for 2021, is qualified charitable distributions, a QCD. And and this, even though the age for RMDs changed to 72, the age for this is still 70 and a half. They may eventually change it, but it hasn't changed at this point. After 70 and a half, you can transfer up to $100,000 each year, tax-free, from an IRA to a charity. And it counts as your RMD, but isn't included in your adjusted gross income. So it's a tax-free transfer. So this is just a great way, if you do have a big RMD, maybe you have a big RMD that might have put you up near the high income surcharge, but if you do have a big RMD you have to take, and you were going to give some money to charity anyway, instead of taking that RMD, having to pay taxes on the withdrawal, then writing a check to the charity, you can just transfer the money directly from the IRA to the charity, not have to pay taxes on it, but it counts as your RMD for the year. And so that keeps that money out of your adjusted gross income, which can do so many different things. I mean, help lower your tax bill. Also keeps it out of the calculation that would affect what portion of your Social Security benefits are subject to taxes for that. And wait, I just wrote down the levels. Social Security, if you have, if your income, and this is your, your adjusted gross income plus non-taxable interest, and half of your Social Security benefits is called provisional income. If it's under $25,000 and you're single, or under $32,000 and you're a joint filer, then your Social Security benefits aren't taxable. If it's from 25 to 34 if you're single, 32 to 44 if you're joint filers, up to 50% of your Social Security benefits could be taxable. And then if that number is more than $34,000 if you're single, or more than $44,000 for joint filers, then up to 85% of your Social Security benefits may be taxable. But anything you can keep out of your AGI, like money that you might have had to take as an R&D, but you can give to charity instead, or money you can withdraw from a Roth IRA or an HSA, can help keep that number lower. So if you need more than that to live on, think of any resources where you could access that money tax-free. And just through the years, a lot of people with Roth conversions, just every year might convert a little bit of money from a traditional IRA to a Roth. And like I said, you have to pay taxes on it that year, but that can help you really control when you're going to be paying taxes on it. And then you can access that, then that money can grow tax-free from that point on in the account. And then you can access it without it being added to your adjusted gross income later on. So I just think that's a great strategy. And there's just a lot of nuances with that. So if you are like this year, some people are still doing it this year because they want to give more money to charity, and they just want to make the tax-free transfer even though they don't have RMDs this year. But next year and in the future, consider that. Talk with your IRA administrator, because it is kind of a tricky, and the money needs to go straight from the IRA administrator to the charity. You can't cash it out, and then, because if you cash it out and then write a check, then it's included in your taxable income, even if you take a charitable deduction, but it is still included in your taxable income. So, but it's just one of my favorite strategies. And it's just a great way to give some extra money to charity and help yourself lower your taxes too. And that is it for all my things. Y'all have had such great questions and points and comments. What all, do you all have any other questions, or do you all have any other information that you want to share? Because I've learned a lot from you.
I have one other question, Kimberly. Could you comment about the effect of giving money to grandchildren in whatever form, and and its impact on them receiving financial aid?
That is, I've written about that, and it's been a little while, but that's a really good point, because there's different ways that you can give money to grandchildren. You could put it in a custodial account for them, but that is considered the child's asset for, and can really impact their financial aid eligibility. You could put it in a 529 account, a college savings plan, and let me try to remember what the rules were. Savingforcollege.com has all the rules in detail about this, but what I believe the rule was is if it's grandparent-owned 529 accounts, it's not counted as a student's assets, but if you withdraw the money from the 529, it's counted as student's income. And so you really need to be careful about those withdrawals. But if they can keep the money in the account till near the end of college, till that junior year of college, after they've submitted that last financial aid form, then it doesn't have the impact, then you don't have to worry about that impact. I would double check at savingforcollege.com, but I think that was one of the best ways. Also with the Roth IRA, I believe it was a similar situation because they don't expect the child to tap the IRA for college, but you don't want to take withdrawals then. But I would just, I wish I knew that more off the top of my head. I used to write about it a lot, but savingforcollege.com is a great resource about that. And actually I've done some old, if you go to kiplinger.com, I think my old articles about that are still there.
So this is Emily. I have a related question. Hi.
Yeah.
So I don't have any kids or grandkids, but I have lots of nieces, nephews, greats. Is there anything to help them, or is what you're talking about really only for grandparents and parents? And
You know, anyone can contribute to a 529 for college. So if you want to help them save for college, that's great. And also the tax rule, you may even be able to get a tax deduction for your contribution. I know you all are probably all in Maryland. I can't remember what the rules are for relatives, but I know there is a tax deduction, right, for the for Maryland 529 contributions. You just need to find, and savingforcollege.com has a whole list about all the rules state by state. But anyone can open an account, and a child can have as many 529 accounts as, there's no limit on the number of accounts they can have. So either you could open an account, and so you could control it and decide how to invest it, but then they would be the beneficiary. Or you could, if they already have an account, a lot of plans are making it easy for anyone to be able to make contributions to that account. So if their parents had an account, a lot of times that, around the holidays and birthdays and things like that, they make it easy to make a gift just straight into the account. So, you may want to, talk with their parents about if they have one already, or may want to just look into opening up one yourself. I know my son has 529s, little teeny 529s, all in a whole bunch of different places based on different relatives. And he's a junior in high school, or he's about to be a senior. So we need to track those down eventually. But I think that's a great way, because that's just, you may even get a tax deduction for it, and then just give a great head start for college. I mean, another thing is, there's more, gosh, I'm trying to remember what there's more services that also let you buy, just a few shares of stock for a child. And even some of the just regular brokerage firms have much lower investment minimums too. So you may want to look into some of the things like that too. It used to be called Share Builder, and I think it's has a different name now, but that could, you could buy stock in something they're interested in, or something that, looks like it might do well. And that's just a great, I know with my son, we've been, I've been showing him how to research stocks, and he's been, picking some investments, and that's just a really neat way for them to get started too.
So are the 529 accounts, is that for a specific individual, or could it be for a group of,
so
I don't know, I have 6 that
you can only have one beneficiary on it, but you can switch the beneficiary. So you would probably, there's all these different strategies people do for families with several kids. Sometimes they keep it all in one account, and then they kind of roll pieces out, as people need it. Some people like having the separate ones, because then you can keep the investments tied more to their age. So if some of the people are, some of the kids are teenagers and some are little kids, you might want to invest differently for the teenagers than for the little kids. One also great thing about 529s is, how there's target date funds in retirement accounts, there's age-weighted funds in 529s, and they do the same kind of concept. They'll start out more aggressive when the child is young, and gradually get more conservative when it comes time to start college. And so if you want to invest in that, you probably would want to have a separate one for each one, so it's tied to their age. But I would say go, and the other good thing is, for 529s, you might get a tax break for contributing in your own state, but you can invest in a 529 anywhere. I think pretty much every state is open to anyone. And so some states may, make it easier to, have a little bit to different kids, or may have, some of them have Vanguard funds, which people, are some, really good low cost funds, and have really good, well-managed, 529s in several of the states. And I think T. Rowe Price, does Maryland's, and they do a really good job too. And I know actually you may want to go to 529. savingforcollege.com and do the link to the Maryland one, and just, take a look at that website. And because I'm pretty sure it's still T. Rowe Price. And they just have all kinds of resources also for just teaching kids about money and things like that. So it's worthwhile to see what they've got.
Thank you.
Right, thanks.
We had 2 comments, Kim, 2 comments in the chat box. One was from Fred Stolnitz, who just said, one strategy with TSP is that you can switch your money into your phone account to another. So if they're going to be taking money out, to make sure that it's taking it out from the account that you want it to come from. And the other was a question about where to find a good fee-based financial planner in this area.
Oh, that's a tough question. I mean,
It's a long one, isn't it? Yeah.
oh my gosh. Well, there's some that I've worked with, that are good in the area, but so just find one in general. I mean, NAPFA, it's napfa.org, is the organization of fee-only financial planners, and they're great. And they can help you find people in your area. They can also, I think in their tool, it's either them or the CFP board. And not all of those are fee only, but those are all the, those people have all met the, the really, really stringent criteria to get a CFP certification. And it's hard because, Mary Beth and Rachel Sheedy, some of our colleagues, we had to listen to them, as they were having to take all these tests and do all this work. So a CFP really is a great standard. But some of the either CFPboard.org, which now is run, their website is run by Rachel Sheeby now, our former colleague.
Really? Oh my.
Yeah. She's doing their consumer side, and they're doing, I don't know if they've rolled out all of the new things, but they have tools where you can find financial planners who specialize in all kinds of different things. So I do know that I think one of the, and I think it's on the CFP board one, there's, if you have military, if you were in the military and you want a financial planner who knows those rules, or maybe even hopefully, if you're a federal employee and you want a financial planner who knows those rules, you can, click on a box and they can help you find someone in your area. And I mean, the good thing is that it really, with technology, expands the area. I have one of my favorite financial planners is in Boca Raton, Florida. And I know she has clients all over the place. And, now that everyone's meeting on Zoom so much more often, if you find someone that's not in your area, it's not as big a deal as it was in the past. But there are in the, Maryland, Northern Virginia, DC area, there's so many good financial planners. There's also, I remember, from living in DC, that there was a really active CFP association in the area. I think it was the FPA, the Financial Planning Association, and most of them, I think they all had to be CFPs, and they would have meetings, once a month. And I know I've gone and spoken to them a long time ago, but you may want to, look at the FPA association in the area and see about people, and then go to their websites, because you go to their websites, they have a lot about what they specialize in. And then also go to finra.org and the SEC both have some great resources about kind of vetting a financial planner, the questions to ask them, some of the resources to look for to make sure they haven't had complaints about them, and things like that. And I think it's FINRA has just this wonderful checklist about, ask your financial planner, how they get paid, if they've had any licenses, taken away, what licenses they do have, and just all kinds of details that you may not think to ask about, and probably won't show up on their website unless you know to ask.
So it's FINRA, FINRA.org. That's
Yes.
yes, and CFP stands for Certified Financial Planner. And we had occasion, because we have a financial planner now, to do the due diligence,
Yeah.
and double check. We had vetted him, we liked him, but just to be sure we did that,
Yes.
and make sure that he had no any black marks, against him. There've been no cases, and he's got a clean record, and that's kind of reassuring. Do we have any other questions out there today? Because those are the only two I saw in the chat box. Is there anybody else who had a question?
Oh, and FINRA, by the way, FINRA's broker check is where you can look up there.
That's what I did.
He
That's what I
has
did, yes.
their own database too. And between the two of them, because there's some of them, it depends on how they're regulated. One may be one versus the other. So just be sure to take a look at both.
Right. Do we have any other questions? I don't know who else is still there. Okay.
Yes, I have a two-part question.
Okay, Fred, go ahead.
Thank you. You mentioned the advantage provided by the CARES Act, that you can, if you got a required minimum distribution early in the year, you can redeposit it up to, I think it was August 31st.
Yes.
The way the financial, okay, first part of the question, if if you look at the way the financial markets have behaved this year so far, am I correct in thinking that unless your IRA is invested in cash equivalents, what you would be doing is the equivalent of selling low and then buying high? And if I am correct about this is the second part of the question, is there any way around that disadvantage?
That is a really good question. That is a really good question because, yeah, I mean, depending on, and the reason why they wanted you not to have to take an RMD was so you wouldn't have to sell when things were down. But unfortunately, you know, a lot of people took their RMDs before that was changed. So that is so Ed Slott is an IRA expert who has, his website's called IRAhelp.com. And he has been writing a lot about these really good strategies for dealing with the RMDs and dealing with kind of the best way to do that. I would recommend looking at that because I hadn't really thought about that. I mean, the other thing is, you know, you may want to, you know, I don't know, you can only wait till August 31st. So you can only wait so long to see how things are doing and, you know, and just, yeah, I mean, that's a really good question. That's a really good question because, yeah, I think they were hoping to get to people before they took out their RMD for exactly that reason. But yeah, so many people just automatically have them taken out at the beginning of the year and would have to be, yeah, things maybe a lot more expensive than they were back then. So yeah, I wish I knew more, but Ed Slott, I'm sure, has dealt with that. So IRAhelp.com, he's got all these just wonderful nuances and he's just a great resource.
Thank you.
Anyone else?
I have a question about, this is Phil. I have a question about the age requirement for an RMD. The law changed last year.
Yes.
Such that you could be 72 rather than 70 and a half, correct?
Yes.
But what happens if you turned 70 last year?
Oh,
I think I heard that I can't go to 72. I have to do it next year, even though.
Were you 70 and a half last year or 70?
70.
That, you know, that's one of those nuances that I at the back of my mind was thinking someone might ask that.
Well, I could ask even harder ones if you want.
Oh no. So if you were 70 last year, that is a good, you know, talk to your IRA administrator because they know all the nuances of the rules. And the other good thing is that since there aren't RMDs this year, and it's not that it's just delayed, it's just no RMD this year. That's another factor too. So, but then you'll have next year. Would you have to take one if you'd be 70 next year? I would say talk to your IRA administrator. Also go to IRAhelp.com because I do know, you know, people who had turned 70 and a half last year had to take it. But if you didn't turn 70 and a half till this year, yeah, I'm not sure. But no one has to take RMDs this year. So you may, yeah, that may solve the problem. And then the question is what do you do the following year? So I'd say talk to your IRA administrator. Also, a lot of the IRA administrators have calculators right now that say, had calculators in the past that said when you had to take their first RMD, and they've adjusted them with the new rules too. So you may just be able to type in your birth date and it can, and I think IRS might even have one now too. And you can type in your birth date and it'll tell you when you need to take your first RMD.
Okay, looks like another chat. Oh, where's the chat? Darn it. Here we go. The question was, does anyone do straight gifts to kids or grandkids? I'm not sure what that, who's asking that. Me not through a 529? Is that the question?
Maybe like just to a custodial account or cash?
And I'm not sure who's asking the question, so.
And the custodial account, you just need to be careful about, just be careful about the impact on financial aid. And, you know, my parents, when my son was young, they opened a custodial account for him, and it was great because it was with Schwab and he could invest in stocks. And now that he's getting older, he's, you know, having more of a say in how he invests it. So, you know, you just have to weigh kind of the, you know, the tax situation. The kiddie tax rules changed, so it's not as big an impact now. And financial aid, look at the impact of that, but also think about, you know, it's a lot more fun for a kid to be able to choose stocks than it is to, you know, have a 529. So, you know, sometimes it's good to have a little bit of each, so they get, you know, so they get the experience, you know, they have the money that's being saved for college, but they also get to learn a lot about investing. Yeah, my son, I mean, you know, there's no school now and there's not much going on. So I did put a little extra money in his custodial account because his birthday's coming up, and said, you know, if you research some stocks and give me a good reason to invest in them, then you can take some of that money and buy some of these stocks. And especially now, so now he's looking at things that really tanked. He wants to be a value investor, and he's trying to figure out, you know, if the airlines, if it's going to be worthwhile to invest in airlines. But it's really cool because, you know, he's at that age where he can start to really get interested in that. So I think, you know, I think that's it's great to have a little bit of both.
Okay, I think we have some comments in the chat, which you can take a look at also, but I think we've pretty much covered the topics, and we can't thank you enough. This was wonderful.
Oh, this was great to meet you all. And oh my gosh, I learned a lot. I know now I learned all of the questions I need to figure out answers to. I also learned about so much about the contesting the high income surcharge and the nuances.
That's a big deal.
This was really helpful for me.
Okay, excellent. And
thank you very much, Kimberly. I appreciate it. I'm sure everybody learned something. This was excellent.
Yes.
Thank you.
Thank you.
Thank you.
And if you think of any questions, you know, you could always email Barbara, can pass them on to me, because that's
I'd
what
be
we
happy
did for years. I really miss doing that, and it's just really great to hear from all of you and to learn from your experiences.
As Kim knows, she was our resource also as my kids were growing up, and as they reached to a kind of young adulthood, it's called, you know, they give me questions I couldn't answer. I said, oh, I'll just forward that to Kim. She'll tell me what to do.
It's JM New York. They always had great questions.
There are kids here now, so this is wonderful. Okay, and if you're willing to take more questions like that, I will take them and forward them to you. All right.
Awesome. Thank you, Barbara. It was great to see you. It was great to meet all of you.
Thank you so much.
Oh, thank you.
Bye-bye.
Thank you.
Thanks.
Okay. Alan, take it away.
Thank you. Thank you, Barbara.
Thank you. All right. There we go. Okay.
We ended up with 13.
All right. You're the one who has to close the meeting because you're the host. Okay. Thanks.
You can log off.
Yeah. Well, I know. Yeah.